So over the long haul, the stock market returns about 7% to buy and hold equity investors, and that includes periods where you'll experience significant drawdowns, such as what happened during the Great Recession of 2008, where the market lost more than 50% of its value from its peak. That's just an inadequate return for anyone interested in seriously increasing wealth, and it certainly isn't an adequate return for active traders. But options income trading affords you an opportunity to do a whole lot better than that. I'd like to show you just one example out of literally hundreds of strategies employed by options income traders who want to find a way to get past that world of insufficient returns that most traders are used to in the stock market. The incredible thing about this strategy is that it's amazingly simple to execute, and it just happened to beat the hell out of the market in the last 2 years. What I want to do in this video is explain what this strategy is, the logic behind it, and how easy it is to implement. So if you're interested in a strategy that would have returned 71% on your money during 2007 and 2018 while the market was up only 12% over that same 2-year period, then stick around because I'm pretty sure you're going to find this to be an eye-opener. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world trading both remotely and in our offices here in New York City. You'll want to click our subscribe button right now so that you don't miss any of our free trading videos produced for the trading and investing community. Now in this video, we're going to be discussing an options trading strategy combined with a simple, well-known technical indicator, and we'll be running through a powerful example of how it would have worked out over the last few years. I'll take you step by step through the process of implementing this simple strategy. And if you'd like to learn 3 real-world option strategies that our traders use, including the surprisingly simple and powerful strategy that some of the greatest investors in the world like Warren Buffett use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so don't worry, you won't lose this video. Also, you can visit optionsclass.com to register for this free intensive workshop. It's an extremely rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Okay, so let's start out with the basics. If you've been around the financial markets at all, you've probably heard of the 200-day moving average. It's simply the average closing price of a stock or index over the last 200 days. Simple as that. The 200-day moving average of the S&P 500 is a very widely used indicator of the strength of the stock market. When the market falls below its 200-day moving average, it tends to struggle for a while and sell off. So if you're long stocks, you'll find this to be a very troubling time. If you're a buy and equity investor, these periods can be really stressful. So what we did was we designed a bullish option strategy that basically stays out of the market when the S&P 500 drops below its 200-day moving average, yet is very conservatively positioned so that it will do well even if the market drops after you enter the trade. And if it drops below its moving average for more than a week or so, we just don't enter the trade at that point. We just move on to the next trade, which we will initiate once the market moves above its 200-day moving average. So by now, you must be curious what this strategy actually is. It's actually incredibly simple. Most people are familiar with options on stocks. A call option gives you the right to buy a stock at a certain price, even if the stock price has gone way above the strike price of your call. And a put option gives you the right to sell your shares at a certain price, even if the stock price has dropped way below the strike price of the put. But there's another kind of option called an index option, which has one major difference from stock options. With index options, you can get paid off in cash. Index options don't involve shares of stock at all. With index options, like options on the S&P 500, for example, if you buy a put and the index goes below the strike price of that put, For each option you own, you are paid $100 for each point below that strike price that the index hits on the day that the put expires. The opposite is true for index options on calls. If you buy an index call and the market rallies above the strike price of your call, you get paid $100 for each point above your call's strike price. Now, as a trader, you can buy shares of stock, but you can also short those shares. Similarly, with options, you can short options, in other words, sell them, and then you get the premium that the option buyer is paying. So for example, if you sell an index put option, but the index rallies above the strike price of your option, then you get to just keep the premium from that put that you sold on the day that the option expires. You have no further obligation. Okay, so now that we've got that definition work out of the way, here's how this simple strategy that I've been talking about works. You put this trade on every month around the 10th of the month. You're starting 70 days before the expiration date of the options that you're trading. So the first thing you do is to check if the market is trading above the 200-day moving average. So let's go back to November of 2016 and see where the 200-day moving average of the SPX, the S&P 500 index, was 70 days out from the January expiration of the options on the SPX. As you can see on that day, November 11th, 2016, the market was trading at about 2165 and the 200-day moving average is below 2100, so we have a green light to enter the trade. The market's trading above the 200-day moving average, so what we do next is simple. Now, with any online broker that allows you to trade options, the broker has models that estimate how much the price of an option will move when the asset it is derived from, in this case the SPX, moves 1 point. Those estimates are called deltas, and every online broker will assign a delta to every option regardless of how close or far away that option is from where the index or stock is trading. Don't worry exactly how to use deltas right now. You can learn that another time. The point is simply that the farther away an option is from the money, the smaller its delta is. An option at the money has a delta of about 50, but if it's very far from where the index is trading, it can have a delta of 10 or even less, into the single digits in many cases. You don't have to calculate this yourself. Your broker will calculate it for you. You don't even need to fully understand what deltas are. You just need to know which delta is assigned to the options on your options chain, and then you'll be ready to implement this strategy. So in this case, we find the closest to a 10 delta put option for SPX, which as you can see in this example is the SPX 2000 put, 70 days out for the January expiration, and we sell that put for a price of $18.10 times 100, so you get in $1,810 in cash. Then for protection, we slide 50 points lower on the index to buy the 1950 put for $13 times 100, or $1,300. This transaction, selling the put and then protecting it with a put that we buy, is called a put credit spread. And in this case, we received $510 for it because we sold the closer to the money 2000 put for $1,810 and bought the farther from the money 1950 put for $1,300, which leaves us with $510. Now, your broker will require you to have about $4,500 in your account to execute this trade, so we consider that the capital utilized in this trade. So basically, if the market closes above 2,000 on January 20th when the option expires, then the 2,000 put just expires, and so does the one you bought at 1950, because for either put to have value to the one who owns it, the SPX would have to be trading for less than 2,000 on the day it expires. So if SPX is trading above that price, it expires worthless, in which case you just keep your $510 that you got for selling the put spread, and the buyer of that put spread is holding something worthless and just lets it expire. Well, as it happens, the SPX traded up to 2250 on January 20th, 2017, the expiration date of the put spread that we sold, and the options just expired worthless. So the trader would have just pocketed his $510. So the rules of the trade go like this. Around the 10th of every month, you find the monthly options chain, which is 70 days into the future, and you sell the 10 delta put, which can be hundreds of points below the market, but sometimes closer, unless the 10 delta put is above the 200-day moving average. In that case, you go right to the 200-day moving average and sell that put instead. Then you slide down 50 points from your short put and you buy the put which is 50 points lower. The net you received from selling and buying those particular puts is what you get to keep if the market closes above the short put, the one close to the money on the day of the expiration of the options. The only exception is this. If the market ever drops below the 200-day moving average for more than 5 trading days and it's time to start the trade, you just skip that month. If in the next month the market is above the 200-day moving average, you initiate the trade. So you'll skip some months. And that's a good thing, as I explained, because this is basically a bullish trade. And if the market is below the 200-day moving average, there's a heightened chance that the market will become bearish, which is not good for this trade. Now, from a risk management standpoint, and there will be losing months where the market sells off and you have to get out of the trade at a loss, the most you can let yourself lose, your stop, in other words, is twice the cash you brought in for selling that particular put credit spread. So if you brought in $475 for a particular spread, the worst loss you're allowed to take before you must hit out of the trade is $950. And that's going to happen now and then. All trading strategies have both winning and losing months. Now, around the 10th of the next month, we were ready to enter into the February trade, so we looked at the options chain about 70 days out. Now, this time, the market had rallied up to 22.53, and the 200-day moving average had risen to 21.20, still below the market. Well, it so happens that the 10 delta put is exactly at 21.20, so the 200-day moving average is not below the 10 delta put, so we can initiate the next trade by selling that put at 21.20 and buying the 2070 protective put and taking this time $505 in net credit. That's because when we subtract out how much we bought the lower put for from the cash we received for the higher put, we're left with $505. Well, by expiration, February 17th, the SPX had rallied further to 23.50. Thus, both the 21.20 short put and the 2070 long puts expired worthless. And again, we get to just pocket that $505. So here's how the first 2 months played out. As you can see, we made $510 from the January trade and $505 from the February trade for a total of $1,015 after the first 2 months. Now, one thing you might be thinking about is the fact that the trade is 70 days long, but we start a new trade every 30 days, so you'll need another allocation of capital to put the second trade on. Now, from our backtest, it looks like you'll need about $4,750 for each trade on average, according to how much brokers will allocate to the risk on each of these trades. But you'll need another $4,750 to do the next trade while the first one is still alive. So we allocate $4,750 to the first trade, then 30 days later we allocate another $4,750 for the second trade for a total of $9,500 for both trades. When it's time to put on the third trade, we simply close the first trade and roll that capital into the third trade. So we keep doing this every month so that the most we ever have in the trade for both months combined is $9,500 of capital. Incidentally, closing the first trade to roll the capital into the third trade has a cost. It's not done for free. The returns we calculated for 2017 and 2018 for this trade take those costs into consideration and deduct them from the profits. If we just let the trades expire and didn't close them, we would have made a lot more money, but then we would have needed much more capital to run the 3 trades simultaneously, and that would have brought down our returns ultimately. Now, after running this trade strictly, following the rules for all of 2017 and all of 2018, we just blew away the stock market. While the market made a terrific 19% return in 2017, we made 49%. And while the market lost 7% in 2018, we made 22%. And this includes winning trades, losing trades, and the months we skipped because the market was trading below the 200-day moving average at the time of initiation. So I hope that this video successfully demonstrated the power of selling put credit spreads in a very simple, easy to understand strategy that just takes a commonly watched indicator, the 200-day moving average, and allows it to act as a precautionary signal to stay clear until the market settles down. You see how it handily outperformed the market, even making a terrific return in a year where the rest of the market lost money. So with option strategies, you don't have to just close your eyes when the market is in trouble. You can deftly trade around those situations and come out ahead of the buy and hold investors and their mediocre returns. Now, just to remind you, as I said earlier, if you enjoyed this video and would like to learn 3 more real-world option strategies that our traders use, again, including the surprisingly simple and powerful strategy that some of the greatest investors in the world, like Warren Buffett, use all of the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like, where you'll make your target profit where the stock goes up, goes nowhere, or even goes down a small percentage. Then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right-hand corner of your screen. That will open the free registration page in a new window so you don't lose this video. Again, it's an extremely rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Now, one more thing I'd like you to do is to go ahead and click our subscribe button so you don't miss any of our trading videos produced for the trading and investing community. And while you're at it, please add your feedback in the comments section for what videos you'd like us to produce next, as well as what you found helpful from this video. So from all of us at SMB, trade well.